All right, so happy Veterans Day to all of our veterans in our Market Scholars community and those that watch our Market Outlook videos. We recognize how important your service is, and especially those that we don't have with us anymore. We remember them and remember their service and sacrifice too, as we do in the summertime as well on Memorial Day. But we recognize, that a lot of you are veterans, and a lot of our loved ones are veterans. So on a day like today, we appreciate that and recognize you. And the markets, while the bond markets were closed, the stock markets were open. We had our big move on Monday, and then today last couple of days we haven't really done much with it. So I'm going to break down now. Are we breaking out here on the intermediate run? We talked about that on Monday. Have we had a couple more days of evidence to suggest that we are breaking out, or has there been more evidence that that's not the case? So I'm going to break that down in today's video, and then we're going to take a look at a stock or a sector that's just one that you wanted to avoid for so long that had its own breakout on Monday, but a lack of follow-through suggests there's a trade opportunity. So let's go ahead and get started. Today is Wednesday, November the 11th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see we're trading inside of the range today of of Monday's body. So the body being the open and the close on the SPX. But of course, that big long shadow, which we don't get very often on SPX, still is looming there with the resistance up there at the top. Also, keep in mind, too, the intermediate line, albeit above the market sentiment line, is rising into the upper reversal zone for the first time in a while. So you didn't do that over here on that low point. So the first time since that overbought cluster that eventually ended up being the peak on the S&P. Now we're back. And again, dark green shading and a green line. And now we start looking for an overbought cluster here to signify the beginning, kind of really solidify the beginning of an intermediate rally. Like, we had a pretty good near-term run here to get up to, off of this low to a new high, and then we've had a little bit of a pullback because of that high point, a little bit of a pullback on the near-term line down to what could very well end up being a bullish near-term low point. The question is going to be where the next near-term high point ends up being. You can see again, we've been below the midpoint on the momentum line this entire past week, essentially, because of these longer upper shadows that we normally don't get. That's kept the momentum line down. You want to finish near the highs to get the momentum line up, similar to what we saw here coming off of these extreme lows to close near the high point. So continuing to get some long upper shadows, not the most bullish, and that's why the short-term sentiment is where it's at. You take a look at some of these other indexes, and you see, well, the Dow Jones also getting that upper shadow, and also getting the intermediate line crossing above 80. But again, its momentum line is down, has been down this entire time, multiple long upper shadows, and then the near-term line's pulling back here. The NASDAQ composite that didn't get the long upper shadow, but got a significant engulfing pattern, bounced back up today. So after breaking into the Fibonacci retracement zone here yesterday, getting back out of it today. So a good sign there. From the S&P standpoint, remember, we broke the 78%, and so far we're holding it. So we haven't broken back down into it yet and kind of done a little bit of a fake out. So good sign from that perspective. And then the Russell, of course, is higher than everybody, and now is higher than its pre-COVID high point, finally. Closing above that yesterday and holding that breakout and getting a new 52-week high point today on an intraday basis. So a good sign from that, even if we were down just a smidgen there, that's kept the near-term line up. So unlike all these others where the near-term line has been down, more on the NASDAQ than on the Dow and the S&P, but then you look at the Russell and the near-term line is strongly higher. Very strong bullish move. Obviously, new bullish highs, well above the September high point, again, that culminated with everybody getting that cluster there. The Russell's been on a bullish stint for a lot longer than the rest of these indexes. You can see there and there. So the Russell's been bullish this entire time, dark green shading and a green line with a little bit of a yellow line, light pink shading pattern there that provided a pretty decent buying opportunity right at that support level. So breaking up to a new higher high, showing bullish patterns all across the board on the market forecast patterns, suggesting that there's a good chance that we can hold, like good breakout patterns that are holding, a good chance that we can hold this. Now the problem is, you know, again, if we get this intermediate run, it's probably going to be shorter because we didn't get much of a near term, an intermediate pullback this go around. But that's okay, right? We can go up to a new higher high. We can pull back after a month. We can pull back a little bit, probably towards the end of the year, beginning of next year, as we get closer to inauguration and anything that might come out of that. The very beginning of the year usually is relatively bearish compared to, like, say, the bullish end of the year and then a bullish spring, late winter, early spring that we typically get. So keep that in mind. That'd be a good opportunity for, you know, a 1 month rally here, maybe 1+ month going into the end of the year, and then a sideways at worst, at best, sideways, at worst maybe more of a 38% retracement. The nice thing is now we don't have to measure our retracement according to this big pull run. We can measure it according to whatever intermediate rally we get coming out of that. So the lines are going to be a lot closer to each other now. We don't have to worry about this big move here. I'll leave that on just in case by the end of this week we end up back below that 78% level and we have to continue to use these. But for now, it's looking like we got the signs, the beginning, some signs of breakout patterns here. All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos and you want to let us know, click that thumbs up. That's a great way to let us know that you want us to keep doing these. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have about anything I discussed? Post those in the comment section. Join our website at marketscholars.com. There's a link popping up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here on the video, check out our Market Outlook live video. Every day I do the Market Outlook. I also do the live video here. I review all the old trade ideas in the old Market Outlook videos that we've done. We continue to manage them. We closed out a couple here today and added on today's before the market closed. So if that interests you, then check that out. Again, all of our subscribers, our premium and our plus subscribers, all of our paid subscribers get access to the Market Outlook Live. They also all get access to our trading rooms. And you can see a couple here. Our Q&A sessions are for our premium subscribers in addition to our class forums where we have custom content and discussions with other market scholars, and then our premium tools and resources, including these charts that we have on here. I get the question, you know, what charts do we use here? All of these indicators and charts are available for all of our premium subscribers, in addition to our trade alert system that we use. We use Telegram for our trade alerts. So check that out, and then come down here, hit that heart, that opens up a new window, hit that like button there. Also hit this thumbs up icon, also opens up a new window. Invite you to click that like button. Again, the more people see, the more you do that, the more Twitter and Facebook will promote our content to all of our followers instead of just 112. There's over 1,000 at least on the Facebook page. That kind of gives you an idea of how many engagements it needs to get this out to all of our followers. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, one of the other issues I wanted to talk about too in terms of limiting the upside is the fact that here's a chart of all the stocks that are 20-day highs. We reached this 2 standard deviation level, which you can see over the past year. We don't get to very often. You can see if I go out even just a couple of years here, we don't get above the 2nd standard deviation. When we do, we tend to see some weakness, at least in the short term, and that's kind of what I expect here. I mean, in this case, back in 2019, it was very, very brief weakness coming off that May pullback, and then we turned around and kept going up until more of a decline there. So, and then you look at like this pullback that we had and some other intermediate pullbacks, you can see we spent a pretty decent amount of time underneath the mean. We didn't spend very much time underneath the mean here on either of these drops. We came down, we bounced right back up. So not your typical intermediate pullback that you can see here and here where we stay down for a while. We've, without any big jumps, we've got even this jump got us up to a very strong 2 standard deviations there. So very, very strong extreme moves in both directions until you get, some ups and downs that aren't so extreme. That's when I feel more like we've had an intermediate pullback. So like I said, if we get a month out of this, then we'll probably end up getting something more like this here eventually coming into the beginning of next year. That can last a little bit longer. I also wanted to bring up this chart here, the relative strength line of the Qs relative to IWM. I talked about how on Monday we closed below the 200-day moving average for the first time in a very long time, like a couple of years here. It was all the way back to February of 2019. Just remember that date. I'm going to pull this up here again in another part of our video. But February the 22nd of 2019 is the last time we touched. After that, we really took off and then stayed pretty bullish into COVID and then beyond. And then now again, like I said, and then yesterday we really solidified the breakdown below the 200-day moving average before bouncing back up. So with a very deep MACD, the last time a MACD has been this deep was back over here in early June, coming off of that peak where this is where the stock market peaked. We pulled back in June because the Russell 2000 really took off compared to the NASDAQ to the tune of very strong negative momentum here. Very similar pattern here. Very strong negative momentum on the Qs relative to IWM. Last time it coincided with a peak in equities, and we had a pretty decent run here. Eventually, just some weakness first, and then the NASDAQ kind of took off, and the stock market took off with it. So now the question is whether or not we are bouncing back up. If this is dissimilar to this jump, is this the peak, or do we still have some more days or 2 or 3 where we're going to trade inside that upper shadow on the S&P before we finally pull back around? Let's take a look at the weekly candle. It's looking very, very bullish, and again, still very high PPO, which would also suggest if we're going to be bullish here and we're going to get some more bullish candles, which you would expect, it's a really good bullish candle there, then we'll probably get maybe 2 or 3, maybe a 4th one before things roll back over. We'll see if we get some new highs out of that 36.45. We're pretty well off of that high point there. And then there's the Dow's very bullish breakout type candle there. The NASDAQ, not so much. So we don't have to necessarily get bullish. That's not a breakout pattern at all. And very well could be very limited in its upside over the next little bit compared to, say, something like the Russell, which is also kind of breaking out here and is finally breaking out of its all-time high. It's got up to an all-time peak on an intraday basis here today. Finally, let's look at the 3 green arrow chart for the S&P. Obviously, 3 green arrows. The MACD histogram suggests we might be slowing down a little bit. You can see the histogram there, but the MACD itself is relatively high. The averages for MACD and stochastics are rolling over. The question is, are we slowing down? The stochastics slowing down, the MACD histogram slowing down. Are we doing this again? That's going to be the key to watch over the last couple of days of this week to see whether or not we're going to roll over into next week and finish filling in these gaps. Speaking of gaps, you can see that we started to fill in the Monday gap for the S&P 500. Just to kind of give you an idea, the Qs more than filled it in, right? It didn't have a gap on Monday. And then obviously we came down, we filled in these negative gaps. But you can see we've already filled in last Thursday's gap and some of last Wednesday's gap. Keep in mind, on the S&P 500, there's Thursday's gap there, and then Wednesday's gap. Now look at IWM, and IWM, we haven't filled in much of Monday's gap at all, much less Thursday's or Wednesday's, which didn't have an upward gap, actually had a lower gap. So you can see all these indexes are various stages, but considering what the S&P and the Qs have done, you can expect, especially with very little volume below here, you can expect that the S&P has a pretty decent chance at filling that, or excuse me, the Russell has a pretty decent chance at filling that in. The Russell, and for that matter, the Dow Jones Industrial Average, which also has not filled in that gap. And then of course there's Thursdays, and it didn't have one on Wednesday. So there's some room that we can come down again to do what's already been done in some of these other indexes. So, and then you see these gaps here. Now I did want to make mention, speaking of gaps, I tweeted this out earlier. Again, follow me at DavidSettle42 for this content that I put out there throughout the day. But this got put out there, this idea that if you just trade the after hours session, so buy at the close, sell at the open, the next day's open, then you'd be at 50% off that March low point. If you bought at the open and sold at the close, so you only traded the regular session, not the after hours, then you'd only be up 6% since that March low, and a few days after the low, you'd actually be negative. So it kind of goes to show, again, that we tend to get a lot of gaps, and you see that here. You see that in this chart. We tend to get a lot of gaps to the upside from that March 23rd low point. There we go. Look at all those gaps there from the March 23rd. In fact, I'm going to just customize this to take away the scale that's kind of thrown off. And actually, I need to do a daily chart there. There we go. So here's all the gaps. There's the March 23rd low point. There's the first gap. And then ever since then, look at all these positive gaps that have been filled in. So that would suggest, man, we should only trade the gaps here. Well, keep in mind, and this is what I tweeted out, that when you look at all those gaps on this chart, only 2 of them have gone on without being filled in. That would be this gap that never got filled in. That's a runaway gap. And then once we broke through those highs that we established in here with these ups and downs, this May 18th gap that we started off down there, very strong gap. We finished pretty strong as well. That one never got filled in. Those are the only 2 gaps that have never been filled in on this rally. And of course you've got these over here from last week that again suggests that there's a good chance that they get filled in too. So keep in mind, yes, you might be missing out on 50% return, but if you do trade throughout the regular session and hold on to it, they eventually do keep going up. And so the only return you miss out on are these 2. Those are from the close of that day to the open, from the close of that day to the open. Those are the only 2 overnight returns that you could not have recreated during a regular session. With how these go up and down throughout these days, even with all those positive gaps. But it also suggests that for these gaps not to get filled in is highly unlikely. It might take a week or 2, but it's highly unlikely that these will go without getting filled in because they don't fit the criteria typically of other runaway gaps or breakaway gaps. We don't break into any significant resistance. This was our closest that we had to a breakaway gap, but we filled it in almost immediately. So it's not. So that suggests the rest of these are probably also common gaps too. So when I talk about, now again, nothing's 100%, nothing's 0%. So we get, if this is indeed the breakout and we keep going up, like I said, another month or so. I think I have low confidence in that. My confidence level for that is lower. I think it's more likely we do pull back down to another low point here and fill in these gaps. But like I said, if I'm wrong, and we do break out, then expect about a month or so bullishness before we finally do get more of an intermediate pullback that hopefully is not too painful for people. If you take a look at the volatility, or let's take a look at the volume and the range, which again, we got this kind of nice little bounce today, but look at the volume. Look how fast we just tapered down, and then the range was nothing. So with a very, very low volume and a very low range, with ranges pretty high still and volumes pretty high, to me suggests that was a very weak oversold bounce. So that's why I'm not too buying into today's little bounce on the Qs even. And you see the VIX broke down again down to this 90% level, but didn't break it. So and there's a chance again that we might bounce back up. Here's the the September high point where we peaked, and then we had that volatility move. Then we had this volatility move up during this recent low point that we've had, and now you can see. So the pre-September peak was there. The October peak in volatility. There's the September peak at the 80% mark. The October peak in the stock market brought the volatility down to the 85% mark. Now this peak, if this is a peak, has brought volatility down to the 90% mark. So it appears like we're getting higher highs and higher lows. I don't expect a higher high in volatility, but it also again suggests we might not be done. Breaking to, this might be another higher low point, and we might roll back over here again in the short term. I have a higher confidence level in that, lower confidence level that we actually do break the 90% and we take off, because that would also suggest that we're breaking the, not this chart, this one, that we're breaking the 1% mark on the ATR relative to price. So that would mean a lot more days of less than 3.5 points. So a lot more days like today. I don't see a lot more days like today coming down the pike. Today, to me, I expect bigger days, which means more volatility. And today, this very, very small move is, you can see it's, we've had a couple little small downward moves here recently, but this is the smallest upward move that we've had. We haven't had any downward moves yet to mirror this bullishness, which typically you get up and down moves followed by each other. So that's again why I'm expecting some more weakness here, if not by the end of this week, early next week. So to summarize my technical outlook, you've kind of got these two different scenarios. One is that we've had our breakout and we're starting on this bullish intermediate run now. That probably may last maybe a month. The typical is 1 to 3 months. We've been seeing 3, 4, and 5 months, but I doubt it if this is indeed the breakout, because we haven't had much of a pullback, and I've shown you multiple reasons why it might not last as long. That's one scenario. The second scenario is we're not done yet with this pullback, that we get these moves higher that are kind of news driven, but none of them have really broken out of this range yet, at least not on everything but the Russell 2000, and the Nasdaq's been really, really weak, and that's been our leader. So our leader's not leading us into a breakout here. It's been the small cap index, and we saw in June what happened when the small cap index made an abnormal move in one direction. It means that we're not done with the weakness here. So that's the second scenario, and all the things that we talked about there as to why that might be the case. I expect more of that second scenario. Of course, nothing's 100%, so it's all about odds and probabilities, but I think my confidence level in that second scenario is a lot higher than in the first scenario, though we have to be aware of both. And if we don't start getting some weakness here tomorrow or by the end of the week and early next week, then there's a good chance that this breakout's holding, and we're going to keep going. So very, very important next couple of days, and seeing how we follow through on Monday's big open, whether or not the rest of these index fill in Monday's gap, which would lead to more weakness kind of more broadly. So what do you think? Do you agree with that or do you disagree? Let me know in the comment section below. Either way, especially if you disagree, what charts or indicators are you looking at that I haven't shown here that would suggest why you're a lot more bullish than I am or a lot more bearish than I am? All right, now let's talk about what's driving this price action. This is about as risk-on of a pattern as we can get. You can see the rallies in these different equity asset classes and the weakness in bonds and gold. Very, very risk-on type of a move. I did want to go back though. Remember that February 22nd, the last time the QQQ of 2019, the last time that the QQQ IWM relative strength line dropped below its 200-day moving average. From that point going forward till now, you can see the Qs have really taken off. And it hasn't been until recently that IWM has shown any gains. All the way up to that September peak, when we started this current weakness, the September peak there, IWM was flat compared to that, again, that day back in February 19th, or 2019, where the QQQ IWM relative strength line hit below the 200-day moving average. We're hitting below the 200-day moving average again. Now, initially, we bounced up with this leading higher. The other scenario that I mentioned is June. June was the other time we've had such strong negative momentum in that relative strength line like we have right now. Well, there's June. June, we had that big, strong move higher in IWM relative to the QQQ. And you notice from that point, in fact, let's go from that point. So it would be from June the 5th. Was the last day higher. Let me just make sure of that here on this other chart. So it would be this day right there. So that'd be June the 8th was the peak higher. So let's go June 8th. So start the next day, June the 9th of 2020. Going forward from there, and you can see the weakness in IWM relative to the QQQ. Right off the bat, IWM fell about 10%. The stock market itself fell 7%. The Qs were flat, were 0%, down to that late June low point. So again, at that peak, the relative strength line had as much negative momentum as it does right now, where small cap stocks have really gone higher. In fact, you can see that kind of started there in May is when that declined. So May, right about the middle of May here. Let's zoom in a little bit. And let's go to about 9 months or so and see exactly. So there it is in June right there. So yeah, it looks like about May 13th is when that really started. So, you know, if I were to come back here to May 13th, into this level. So there's that big move higher in IWM, and you can see Qs were really lagging in that time frame. They were up about 8%, but IWM was up 20%, so more than double the returns. And then you can see again how things changed when IWM came down to the Qs, and then Qs pulled away. And then Qs had its own parabolic move over here before that September high point. So again, IWM making a big move higher, and we see that starting right here. So it looks like it peaked on where is that? Oh, September the 2nd. It peaked there on September the 2nd. So going back to September the 3rd now. So the next day after that peak on the 2nd, November the 3rd, here's IWM up 9%, and the Qs are down 4%. And you know, we've had these big moves, like, you know, there at that October peak, we were up 3% with the Qs down 2%, and that gap's gotten bigger. So it's kind of making a strong move higher. Last time we saw this, it was a peak in the stock market. So we'll see if that continues to be the case again. Nice thing about the bullishness in terms of a long term is we are very strongly bullish in so many areas. A little too strongly bullish. This is pretty far up above 30-day moving averages in some of these areas like Japan and the UK. Let me kind of give you an idea of what that looks like here. If I were to pull up EWJ, just to show you the strength of how far above and again, we saw that in June, right? Again, when small caps was making a run, we were pretty darn high there in June. So let me pull up the PPO for how far above the 30-day simple moving average we are. So let me do this and this, 30, and then simple. And you can see, you know, we're in the 93rd percentile now. Very, very strong move for the past year. Very similar to what we saw there in June. Remember, it's not just in the UK, it's in Germany, well, not so much Germany, not just Japan, excuse me. Look at the UK, up 9%. We saw that there. Italy was another one that had made a strong move to the upside, up 8% off of its moving average. And then, let's see, where is that? Nope. Oh, here, let's do it on this one. So let's go back to our global 12 grid here. Italy, we saw a big move higher. Oh, and France. We saw the UK just now. And let's take a look at France. Again, these are all these European nations that have been in lockdown. Its PP up 10%. We're above. So again, it doesn't mean we have to go down because we kept going up there for a few days. But it does start to limit returns to the upside until this PPO comes down to a lower level that you can bounce off of to a new higher high. So very, very strong moves. Again, doesn't mean we have to go down, but it limits returns. Like I said, if this is the beginning of a new intermediate rally, then we may only have a few weeks because of how strongly bullish we already are in some of these quote-unquote catch-up trades. All right, if I do that same, if I go back to February 22nd of 2019, again, from the period where the NASDAQ relative to the small caps broke out, you can see the returns. I mean, here's the 73% return on the technology sector, 38% to 40% returns like communication services and discretionary, and all the way up until here lately to that September 2nd peak. There's where your financials and your utility, here's your financials, your industrials, your utilities and real estate, and you can see materials there. Energy really struggling. Energy finally getting a little bit of a bounce here on this late little rally. So coming off of this low point here in, what would this be? Coming off of this October 30th low point. So if I were now to switch to October the 31st of this year, coming into now, then you can see, okay, you know, what's been the big movers, and you can see, especially here lately this week, it's been energy, and it's been financials, and it's been industrials. This is what's led us up off of that October 30th low point here. So coming back to this chart, coming up off of this low point, this October 30th slope, this great move has been led higher by energy, financials, industrials, briefly technology and healthcare, but then they pulled back. And so they're matching the market. And then you can see discretionary, staples, the consumers, again, making up 70% of our economy, lagging behind. Up 7%, it's a good return, but lagging behind the 9% return in the broader market. And then again, you can see double-digit returns in these areas. Not your best leadership to be leading a breakout. We want, again, technology and discretionary and communication services leading the breakout, because that's your big move. You know, those are your big moves. And again, we saw that here today. You saw a little bit of some strength in these sectors today. Technology way up to 2.3%, discretionary communication services up here too, and some lagging in these areas. And that kept the markets bullish today. But remember, low volume, low trading range. So it's not necessarily like the baton's been passed back to these areas. It's more, again, of a oversold technical bounce in some of these spots over the last couple of days. Going into, again, you remember the early part of this week, you can see they were the biggest losers. And so I think it's more of an oversold technical bounce today than anything. And look at those big returns. That's not the kind of returns you want us to lead in. These are some really, really poor areas of the market, especially the energy sector. All right, and that brings us to our trade idea of the day, and it's actually in that energy sector. It is on ExxonMobil. You can see it broke out on Monday, and so far it's holding that breakout. It's not continuing to break out, but it's held the breakout, and we've been so down for so long that, you know, you've got some room to the downside to work with. We've been this high on the intermediate line before. We've been higher during April and May and June. We were relatively bullish here. There's that catch-up trade that all these really, these really weak sectors had back in June. Obviously, it's been bearish, even though the rest of the market hasn't been since then. But nice little breakout pattern nonetheless today. If you take a look at like its Keltner channels and the Bollinger Bands, we broke out on Monday outside of both of them with the bands inside the Keltner channels. That's a pretty decent bullish breakout pattern. It's not necessarily starting off a new strong trend to the upside. We've had such a strong bearish trend going that we've got we're still inside the cloud. We're not through the cloud yet. You take a look at its DMI here, and you see, okay, the ADX is still relatively low. We're not really kind of moving up and getting light green shading or dark green shading, though it is a nice, good directional move with the positive index above 30 and the negative index down below 20. But you see, that's the first time the negative index has been below 20 since over here. And that, you see what, this is a very similar type of move that we got there before we started coming back down to these lows. I expect something very similar to happen again, especially considering that we're just barely there at the 50-day moving average. We are rising in the momentum, but it's very, very weak negative momentum. Ultimately, there's going to be a great trade to the upside in the energy sector. It's just a matter of when we can shake off all this crappy momentum here down to the downside. It's hard to just bounce V-bottom up here like we did back there when things are just so weak, especially when we retest a low point. It's easier to V-bottom when you've got the sharp drop. You can come right back up. But now we don't have this. We retested those lows on a lot slower basis, so you expect if we are going to bounce up, it'd be a lot slower too. So what does that mean? Well, that means we can come over here to the trade tab, and we can sell a put spread because we are bullish there. Sell a put spread, and also sell a call spread because we're not too strongly bearish. So selling the 40, buying the 42.5, selling the 32.5, buying the 30. That sets us up for a trade like this, where we can position size around full maximum gain for about a 30% return on risk, and with a relatively high, according to the options market, a relatively high probability of getting it. That will stay those break evens, as you can see here. Those are the blue lines that you saw on this chart. So there's our break evens to the upside, very strong resistance above that, and our break even to the downside, which are these lows of the year, the 52-week lows. So really good chance that we, at the worst, hold those levels. So it sets us up for a nice, good trade going into a sideways trade. Up and down, it can go up and down. It's got some room to go up and down, but very good resistance and support on either side going into that December expiration. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum where you can open up any new thread with any questions or comments you have about tonight's video. You can respond to anybody else's threads that they post in the forum. Again, our Market Outlook forum is also available for our paid subscribers and our free subscribers. So take advantage of that. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Remember to also like us on Twitter and Facebook too. Have a great rest of your Monday night, everybody, and we'll see you all next time.